All right, welcome back, everybody, to the Informed Home Buyer Podcast. I'm Rich Curtis, and today I'm joined by my trusted lender of over 20 years, Dave Miller. Thanks for being here, Dave.
Thanks, Rich. Thanks for having me. Hi, everyone.
All right, so on this show, as you know, we're trying to help you make the highest quality real estate decisions you can from the comfort of your house and your couch. No jargon, no gatekeepers, just some straight talk, real plain language to help you understand the complicated landscape of buying a home. What does it take? What is expected of you? What does it cost? And today's episode is on what does it cost? We're going to be going over 10 hidden fees that most buyers don't know about, roughly what those are going to cost you, because they are adjustable based on the price of the home that you purchase and when you purchase it, and what you can expect in that regard. Now, to be clear, none of these are actually intentionally hidden fees, but real estate transactions are complicated. There are a lot of professionals involved in getting the transaction over the finish line, and these are fees that most buyers just don't know about, and that over the last 20 years, Dave and I have found when we start going through these fees with people, they're like, wait, what? I haven't heard of that. How much is that? And we don't want anybody to be caught by surprise. So we're going to go through them today. We're going to break it down into 3 different categories: upfront fees, closing costs, and then after closing costs. Most buyers don't know you still have one fee that's going to hit you after the close of escrow, and you got to save and plan for that. So we're going to go over that one at the end. Stick around. You're going to want to see that. So first off, Dave, we're talking upfront fees. And the first one that people don't know about is the earnest money deposit. And we get a lot of confusion around earnest money deposit where people think it's the down payment, and it's not. You're going to choose a down payment. We have a whole podcast that we just did on down payment. It can be 0 down. It can be 5, 10, 15, 20% down. Your earnest money deposit is simply a deposit you're going to place into escrow, a neutral third party who's going to hold that money and not give it to the seller or give the deed to the property to you until all the clauses of the contract are met. Now, it's typical for that earnest money deposit to be between 1% and 3% of the purchase price. They are going to cash that check, and it is going to come out of your account and be held in escrow until the end of the transaction. So we often work with around a $500,000 purchase price on this podcast. It makes the math easy. And we are in the greater Sacramento area where the median home price is around $515,000. I'm up here in Placerville where the median home price is $500,000. So it works. So at the low end, you're going to put down $5,000. At the high end, you're going to put down $15,000. Now, the higher your earnest money deposit, the stronger your offer looks to a seller, but the more money you have on the hook. The contract does protect your earnest money deposit. We can go deeper into that in another show, but essentially for your contingency period, whatever you elect on the contract, we'll work with the boilerplate. What's printed and standard is 17 days. For those 17 days, you can bail out of the transaction as a buyer in our state of California. We've got people watching from all over the country, and this is different in other states. In our state, in California, your earnest money deposit is protected for those 17 days. If you bail out for any reason, you get it back, and it doesn't automatically sunset. You have to actively sign a piece of paper to sign away that earnest money deposit when you're ready to remove all contingencies in the contract. Do be advised, other states like, say, Colorado, it sunsets at midnight on the date of the contingency removal, and it's gone if you don't stop it. So if you're in a different state, you do need to contact an attorney or a real estate agent, whoever handles real estate transactions in your state, to get the details on that. Here in California, you're going to put down 1% to 3% of the purchase price, and it is refundable.
Right, Rich, you bring up a good point there on that earnest money deposit. And for people's clarification is, and when you're buying a home, especially first-time home buyers, when you write that earnest money deposit check, that's when things really become really real, right? But also know, as Rich mentioned, it's protected, but that it's not technically a fee. It's a deposit that gets contributed towards any monies you need to close. So, if we'll get into closing costs, but if your closing costs, and I'm just going to use a round number, are 10,000, but you did an earnest money deposit of 5,000, you only owe another 5,000 to go towards your closing costs. And again, this is separate from any monies that are down, that you're putting down to, lower your loan to value on the property. So, sorry.
Yeah, good point.
Yeah.
No, that's a good point. Yeah, this money is credited to you at the end. It's a zero-sum game. If you're buying a $500,000 house and you put down a $10,000 earnest money deposit, you now only owe $490 on the house. plus your closing costs. So if you go all the way through to the end of the transaction, they do just deduct that from the total money you have to bring in to close at the end of the transaction. And if you bail out for any reason, you get that money back. There are some nuances to this, the only one of which being that the title company technically legally reserves a right to charge you for producing the title report. If you bail out, it would be a $400 to $500 fee. I've been doing this for 20 years and I've never, ever once had a title company execute their right to charge somebody for a title report when they've bailed out of the transaction. So functionally, it just doesn't happen. You get the full amount back. So, all right, inspection costs. So when you purchase a home, it is very important. One of the most important steps is to inspect the property. This is what's going to save you tens of thousands, in some cases, even hundreds of thousands, depending on the problems that might be uncovered. Unfortunately, we have once or twice had a few houses have some serious problems that we've uncovered during inspections. So it's a crucial part of the process. Now, this is going to be different depending on what city you're in, whether you're rural or urban, what state you're in. Different states have different problems with things. Like California, a lot of people don't do a radon gas test. I've done 2 in 20 years. In Missouri, every single home that's sold does a radon gas test, and almost every single seller is going to have to do the remediation for radon gas. So there's some regional things to this. But here in California, if you were to do the bare minimum, you'd spend about $500 on a home inspection. And if you were to do the full slate of everything I'm going to recommend, you're going to spend $1,600 to $2,000 for your inspections. We'll do a whole nother podcast where we go deep into the inspections, which ones to do when and why and how they benefit you. But just know for that line item, you are going to be paying, if you do it right, $1,600 to $2,000 in inspections. Now, that is an upfront fee that is non-refundable. You're going to pay independent service providers, a plumber, an electrician, a home inspector. You're going to pay them, and that money is gone. If you bail out and you had $5,000 earnest money on deposit, you get that back, but you do not get your inspection fees back. So anytime you write a contract to purchase a house and you enter into your contingency period, your real risk, your out-of-pocket risk, is around $1,600 to $2,000 on those inspections. That's what you're actually risking. Now, we're talking about these as upfront fees. Earnest money, it benefits you. You're paying directly to the service providers for your inspections. I should mention, you should not be in the state of California paying any upfront fees to me or to Dave or to any realtor or any lender. Anyone trying to charge you an upfront fee for their real estate or lending services, walk away, find somebody else. It is not standard in the marketplace. It's not really acceptable. We are all paid upon closing. So anybody who's asking you to do that is doing something well outside the norms of the industry, and you should go find someone to work with that is going to be within the norms. You shouldn't be paying for our services until we deliver, which is on closing. And then our final one here is for upfront fees is the appraisal fee. I'll let Dave talk about that. That's his purview.
Yeah, that's good. Good segue, Rich. There. And so when we talk about an appraisal fee, that could be anywhere. I would say into $475 to, let's say, $750, depending on the price of the home. I've seen them go higher if you're buying an investment property, and there's a lot of rent schedules. I don't want to go but appraisal can vary. And keep in mind, once you go into contract, and Rich talked about timelines and contingency periods, there's typically 2 main ones to pay attention to. It's the there's several, but from my perspective, it's the loan and the appraisal contingency. So standard is 17 days on those, and those can change. I will ask you for the appraisal fee. That does not go to me. It does not go to my company. It's a pass through to an appraisal management company. So when Rich talked about the inspection fees, we also considered an appraisal and inspection. When you work with me and Rich, a lot of things that we'll do as you go into contract, and Rich is pretty savvy here, he'll recommend which inspections you should get. And based on timeline, is those inspections usually, or we try to get some of those done before the appraisal. So if there's an eyebrow raised about something on the home, and it takes a home inspector to really dig into that, what we try to do is wait to order that appraisal until that $500 home inspection's done. So if that home inspection finds something that says you better run away, then you haven't paid the fee for the appraisal. So we really try to work together to time that, just to protect that upfront money, because once you pay for that, the appraiser gets paid and that money's no longer, non-refundable. I don't know if you want to add anything to that, Rich.
Yeah, it's a good point, and this is a place where if you're working with experienced realtors and lenders, they can save you hundreds to thousands of dollars. Like I said, you're going to spend 1,600 to 2,000 to inspect a home, right? In my opinion, thoroughly, but not all at once. You have some agents that day one of the transaction, to be efficient, they'll order the everything, all of the inspections and the appraisal, boom, 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 and they're trying to get it done fast. Either because they're under pressure because they have fast timelines, but that's not usually the reason. The reason is usually just to be efficient, makes it easier for them to just get it done. The problem with that is it's spending your money all at once instead of incrementally. And if you bail out, you've lost everything. So often we will have the home inspection done just as quick as we can. We have relationships with these people to get that done. And then we may find out that the HVAC system's brand new and you don't need the HVAC inspections. If I'd ordered that on day one, you're out another 185, 285 bucks on that inspection when home inspector says it's perfect. Don't do it. So we usually try to get that home inspection done on day one. And that's our leaping off point for deciding on some of the other inspections we might need. And we can save you some money there. And also, if the home inspection were to uncover a real fatal flaw or a deal breaker for you, then Dave hasn't ordered that appraisal yet, and we can save you another $400 to $600 there that we can apply to your home of choice, the next home you choose if you are bailing out on this one because it's just not in the condition you wanted it to be in. So the timing of these things isn't something you have to worry about, but it's something we're doing on your behalf to try to limit your financial exposure and do it incrementally. So if you ever do bail out of a transaction, you haven't lost the everything. Now, the everything, like I said, is really only your 1,600 to 2,000 on your inspections and your $400 to $600 on your appraisal. So it's not a ton of exposure, but I'd rather lose 1,500 than 2,500. So we do this incrementally to try to protect you that way.
Right. And, when we talk about you get that home inspection, do we continue with the appraisal or other inspections? If, Rich says the home inspection uncovers something, doesn't necessarily mean it's always a deal breaker. What that means is Rich, with a relationship with the listing agent or your agent, can make a phone call and say, hey, this is what the home inspection uncovered. If your seller's not willing to address this, we're out.
Yeah.
So it's really people working for you and all of us working together and in concert with one another so that we, as Rich said, we kind of check the boxes as we go. So not everything's done at once. You're not holding the bag for, inspections that you didn't need.
Yeah, and that it's very rare that there is a monster sleeping dragon expensive deal breaker on the inspections. It's more often that there's a few things that need to be handled and it's a point of negotiation.
Yeah, good point. And a lot of times it's something the seller's not aware of, and if they don't fix it for you, they're gonna have to fix it for the next guy. So,
That's correct. Yeah.
yeah.
So
Yep, go ahead, Rich.
our next section is closing costs. And so you hear this term, and this is a big blanket term. Closing costs encapsulates a lot of different fees. There are recurring closing costs, which is, we're going to talk about those prepaid items where you're really just prepaying taxes and interest on behalf of yourself. And there are non-recurring closing costs like title fees and escrow fees and those sorts of things. So we're going to break that down now, sort of step by step for you. And for all of this, we can go granular and tell you a title report $1,700, and the lender's policy is this, and for this price house, the transfer taxes are going to be this. But that's all going to change depending on the date of escrow, the date of the close of escrow, and the purchase price of the home. So it's easier to give you a ballpark. We've given this to you before on the show, but Dave and I ballpark your closing costs at about 3% of the purchase price. So at that $500,000 price point, everything we're going to talk about now, this whole closing cost section, should come in $15,000 or less, and it will be less than 15. That 3% is a conservative estimate, so that when you get the numbers, are always better than that, because we don't want to tell you it'll be 10 grand and have it come in at 12. That really sucks. Better to tell you it'll come at 15 grand and have it end up being around 10 to 12, which is probably realistically where it'll really land. But just know that everything we're going to say right now, if you start being like, well, I can't keep track of this number, that number, whatever, 3% of the purchase price will give you the total cost, the total maximum cost for the whole section that we're going to talk about now.
Right. And Rich, you bring up too, and I know we're going to get to this, the recurring and non-recurring closing costs. And when we talk about 3%, or even somewhere around 2%, so a $500,000 purchase price, if your fees were 10,000, typically almost half of those are what's called recurring closing costs. That's money you're going to pay anyway. And we'll kind of dive into that. So the real hard costs are going to be those, and a lot of these fees that we're talking about are going to be separate from the inspection fees that Rich has charged. They're going to show up on a settlement statement that I will provide for you, a loan estimate, and then a closing disclosure. But none of the fees that Rich charged will show up, or not, or Rich, his inspectors that he lined up. Those payments will go directly to those inspectors, and those won't show up on the fees that I'm going to provide. But they're typically within that 2 to 3% closing cost number that we give, estimate that we give you. Yes.
Yeah. And so everything, the other ones were upfront fees. Those are fees you're going to pay out of pocket as you go along in the transaction. Now that we transitioned to closing costs, they are what they say they are. They're fees charged at the closing table. If you fail to close or don't close a transaction for any reason, these are fees that you don't incur. So we have our title and escrow fees, right? Now, title and escrow are technically two different things, but for the most part in California, we're usually using the same company. It's a subsidiary of the company that is doing both tasks. Escrow is just a neutral third party. They're going to hold your money and the deed, and they're not going to exchange those two things until the realtors tell them all the clauses of the contract have been met. And they're going to be the one who holds your earnest money deposit in trust until that happens. When you transfer all your fees in and all your monies to close, they're going to hold those in trust until the property actually closes. So they provide a crucial service to everybody as a neutral third party. They don't have a dog in the fight, a negotiation stake in the transaction. Title is going to offer title insurance. And so they're giving you an insurance policy. Now, if you are buying cash, there's just one, an owner's policy. Like I said, it's going to be around $1,800. But if you have a loan involved, you're also going to have a lender's policy involved. Now, with the owner's policy, in our areas, Sacramento County, Placer County, El Dorado County, Amador County, the sort of standard, it's not required. You can negotiate any way you want, but the standard is either to split the owner's policy 50-50, buyer to seller, or to ask the seller to pay for the whole thing there. When it comes to the lender's policy, buyer always pays the policy for their own lender. When it comes to the escrow fees, the vast majority, like 99.9% of the time, that's going to be split 50-50. It is a point of negotiation. We can change that. And sometimes if we can't adjust a purchase price, but we're trying to move money around in the transaction, that might be one lever we can pull, and we might adjust that. But for the most part, you're going to split that 50-50. Now, title and go ahead, Dave.
On that point, Rich, when you mentioned escrow fees, so that's what we call fees that are going to go to the escrow company, but there's a separate escrow fee or settlement fee, and then a number of other miscellaneous fees that the buyer's always going to be responsible for, or almost always be responsible for, that will go to the escrow or title company. So just wanted to,
Yeah, good point. And we'll give you a settlement statement that shows up. You're going to see all kinds of notary fee, wire fees. You're going to see, recording fees down at the county, all kinds of little fees. Again, going granular with that will just make you bleed from the ears, but just know that that's going to be encapsulated in that 3%. And it is all transparent and it's on paper. It's just good to know up front that all these fees are going to come up for you. Now, those are all non-recurring closing costs. Those are costs you're paying for the privilege of having somebody help you process this transaction. The next part of closing costs, and I'm going to punt to Dave on this one, is the prepaids. These are things you're going to pay in advance for yourself. They will eventually benefit you. You're just prepaying some of your bills. So it can feel like, holy moly, that's a lot of money. But remember, that's not money going out to somebody else. That's money just prepaying your bills so the lender can feel secure that you have that money set aside to pay those bills. So Dave, do you want to go over how prepaids work?
Yeah, the way that works is, and so if you're coming from a rental situation, when you live in a rental, you pay the first of the month, and that covers you forward for the rest of the month, the time you're going to live there. When you buy a home and you purchase a home, mortgages are in arrears, and which means that you're going to live there, then you're going to pay backwards that 30 days of interest, and then any principal gets paid really backwards. And so when you close, in this business, we talk about closings when we fund and record on a purchase. And so that's really when we close during a month, and what month we close is really going to impact what we call your prepaids or your recurring closing costs. And these things are prepaid taxes and prepaid interest. So what will happen if, what's today? Today's the 20th, 21st. If we're going to close on, we'll just say the 20th, 31 days of the month. If we were to close today, you're going to pay prepaid interest from the 20th to the 31st. So 11 days of interest you're paying upfront, based on your, mortgage balance and your interest rate. Then you're going to live there for the following month, you're going to live there the rest of the month, and then the following month, and then your first payment's not due till day one of the following month after that. And I'll bring up a chart here when we're talking about also prepaid taxes.
Yeah.
So oftentimes when you close, there's going to be a property tax bill, reimbursement that will go towards to the seller for taxes they've already paid, and then you're establishing your own taxes. And that could be anywhere, and we talk about reserves, anywhere from 1 month to 7 months. And, this might be a good time to bring up this is typically the most expensive part of the transaction here in terms of fees. And what happens here, and let me, I guess I could share my screen here, Rich. Let's,
yeah, throw that up and I'll add it to our
let me
panel
go, slides.
While Dave's getting that up, just to clarify, so we're talking these prepaids. We're talking about taxes. You're prepaying taxes for yourself, or in some cases, refunding the seller for those taxes. You're prepaying your insurance, which Dave's going to talk about for yourself, and you're prepaying the interest, like he just talked about. And these are all prorated based on a 30-day month. So when it comes to refunding a seller for taxes, you're just paying him back for taxes he paid for the duration of time that he's not going to live there. Or if you end up paying the tax bill in escrow, then he's paying you for that. These are prorated based on a 30-day month. Then you're establishing, like Dave says, a prepay for your own taxes, your own insurance, and the interest on your own loan. And that's all of the prepaid fees.
Yeah, Rich, it just wanted me to upload something. Let me try this a little bit different here. Share screen. There we go. And then
Sure.
there we go. That should have come up there. Are you
Yep,
able
there we
to
are.
share that? Okay. All right. So again, as I mentioned, when based on the month and the time you close, your first payment due. So if we're in November, the third month down, your first payment's not due till January. So the estimated number of months you're going to collect is going to be 4 months of reserve. So if we use a 1.25 of the purchase price, so if you were to buy for 500,000, we take times 1.25%, divide that by 12. You're looking at $520 a month, and then we're going to collect 4 months. So you're looking at basically 520 times 4. You're looking at about $2,100 that would be collected in your impound account. When we talk about an impound account, it's an account with your lending service company, whether it's us or whoever your lender is or the servicer. They're going to keep an account for you where they will disperse your property taxes twice a year. They will also collect 1 month of your homeowner's insurance or hazard insurance, where they will disperse that once a year. And so that's also a recurring closing cost. So not only do you pay that $2,000 towards your impound account, 1 month of insurance plus the full year premium of hazard insurance. And that, based on where you're buying, that could really vary quite a bit. And that we could probably do a separate podcast on that as well. But
I think
really,
we will. We'll get an insurance agent on, hopefully
okay.
Aurora Mullet, and kind of go through, because that's a big deal in El Dorado County. So yeah,
right.
that's coming up, guys.
Right. And so if your hazard insurance is $2,000 for the year, 160 or 70 a month, that still gets paid up front. That's a recurring closing cost. So that's where it seems very expensive. But what it's doing is it's covering you monthly, but it's just paid up front.
Yeah, and you don't always have to do this, especially if you're a cash buyer. You're not going to have an option to do this. You're going to have to pay your own taxes and your own insurance as those bills come in to you. If you're a buyer with a loan, in most cases, a lot of lenders will require an impound account, and even if they don't, most people are going to elect to do an impound account because it just makes things easier.
Yeah, and there's some incentives on the pricing. Lenders really deem you a little less risky if it's impounded, because most people can budget for one payment a month that includes taxes and insurance. But if you get a surprise every 6 months and you get a $3,000 property tax bill that you didn't kind of budget for, that becomes sometimes a challenge for some folks. And so
Yep.
And as Rich mentioned, if you're putting less than 20% down, almost always you're required to have an impound account. So where the
Correct.
option is when you're putting 20% or more, you have the option. And at that point in time, I would share with you what the pros and cons are and if what the cost difference would be to go with or without an impound account.
Yeah, and by and by and large, the people I've encountered who want to pay their own, there's two kinds of people I've found who want to pay their own. There's grumpy guys like my father who's like, I'm not giving anybody a penny of my money before I have to, right? There's that just on principle. And then there's people who, we've had a client, you'll know who I'm talking about. They move their money around like from a 5-month CD to a 2-month CD and they're always moving money around and scraping a $100 or $200 margin on interest. They're just really actively managing their money. And so for them, they're like, well, wait a second, I can keep that and make a couple $100 on it before I put that money and pay that off. I can put that money to work for a little bit. And so there's a kind of two categories of people I found that do it. The vast majority of my clients, myself included, and probably Dave included,
Yep.
I just have an impound account, set it and forget it. It's 2 bills. I got enough bills. I run a business. I got 2 kids. I own property. I got enough bills. If someone else is going to pay my bills for me, I'm in. So,
yep. And that brings up another point too, is you're still going to get your property tax bill. And for first time home buyers that are doing an impound account, every time at tax season. So the county's going to send out one tax bill for you and it's split into 2 installments.
yep.
So if you look here at the bottom of this sheet that I'm sharing, if that's still sharing there, you'll see the first half is due on November 1st and then late after December 10th. And the second half is due on February, delinquent after April 10th. So they really look out for you. They do it during the holidays and tax time. So, that's when you owe more money anyway, usually. But inevitably you're going to get, if you have an impound account, you're going to get a copy of your tax bill. And the first thing that people do is they open that up and go, oh, shoot, there's a $3,000 or $4,000 bill. They call me. You said my account was impounded for, I'll say, okay, take a look. It should say copy on there. You're going to get a copy. Ultimately, it's your responsibility to make sure that your loan servicer paid the taxes, but you're going to get that bill and it will almost inevitably get paid out of your impound account. With the exception of the supplemental tax bill. I don't know if Rich, if you were ready if this is a good segue into that.
Well, we'll cover that towards the end here because we got a couple more things. So to wrap up the closing costs section, we started with our upfront fees. Just a quick review. Our upfront fees were our inspection costs, our earnest money deposit, and our appraisal fee. We just covered our closing costs, and these are thousands and thousands of dollars, and they sometimes blow people's hair back. Like I said, this is gonna be in the probably $10,000 to $12,000 range for a $500,000 purchase, but the vast majority of those fall under these prepaids. So you're going to be prepaying interest on your loan. You're going to be prepaying your hazard insurance, which, like Dave said, down in the Sacramento area, it could be $2,000 up by me. It could be $5,000, $6,000, maybe $9,000 if it's a big home, and that sometimes it's the only cases where our 3% rule gets busted every now and again is if someone's buying a really large, really expensive home on acreage in the foothills where they have a $9,000 or $12,000 annual hazard insurance bill. Every once in a while, that can push these fees up a little bit higher, but the vast majority of people will fall in that 3%. So you're prepaying taxes and your interest and your hazard insurance. And when Dave did that little 1.25% calculation, that's something you can do for yourself. Your ad valorem tax, which is just Latin for standard, your standard tax levy, what they call it is 1% in the state of California. So that's easy math. You got a $500,000 house, you're going to pay $5,000 a year in taxes. However, there is always a couple little penny ante, $50 for the ambulance, $25 for the libraries, $100 for the schools, whatever it is. Special assessment taxes, those add up. So you can ballpark that by adding another 0.25 to it. So you just take your purchase price, multiply it by 0.0125, and that gives you an idea of what your taxes are. And if you want to see how that affects your payment, you divide it by 12 months and you add that to your payment. Same with your insurance. You're going to have $5,000 for your hazard insurance, divide that by 12, add it to your payment. And I break that down in several other videos, how to accurately get your payment. But the easiest thing too is just give Dave a call. It's free and he can just crunch those numbers for you and give you accurate stuff on that. So that's where we're at now. We have covered upfront fees. We have covered closing costs. All of this, again, is going to run 3% or less of the purchase price. And our final section here is going to be 2 surprise fees, right? One is pre-closing and one is post-closing. So the one pre-closing that people don't know about, and it's not actually a fee, it's just money you have to have sometimes, is reserves. A lot of people don't know about this requirement. So you're thinking, okay, I got to have my, I'm putting 5% down. Got it. I got to have my 3% for closing costs. Got it. 8% of the purchase price. I'm good there. I've got my money. But in some cases, and Dave will kind of break this down for you,
Yeah.
you need to have reserves, meaning the lender wants to know that the day you make your first mortgage payment, you're not tapped out, zero account balance, that you've got some gas in the tank, right? So Dave, talk about sort of who
Yeah.
has to pay
So
reserves when and what those have to
yes.
be, and what assets qualify.
Yeah, that's a good point, Rich. So reserves can be cash on hand, or well, in the bank, verified funds, whether that's, checking, savings, CD, retirement funds, typically 401k, 403b. We can't use, for public employees or teachers, we can't use PERS or STIRS as reserves. But the
So
reserve,
pensions don't count, 401ks do count.
that is correct.
Because it
Yep.
has to be basically liquefiable assets is what.
Yes. So someone could liquefy. You might have a tax implication for yourself, but you can't just, tap your pension when you want to
Right.
in case you have an emergency. So
Yep.
that's what we look at reserves, and reserves are going to be different for every borrower, every situation. And so we run every loan, or almost every loan gets run through an automated engine that tells us what the requirements are. And I've been doing this long enough, and I kind of have a general idea of the requirements, and I'll state what those are. And I'll say, hey, before this is set in stone, let's just run it through and see if it approves. There's no cost to you for us to run it through the, Fannie Mae's underwriting engine. And so good credit, a little bit of money down. I've seen it with 1 month of reserves or no reserves. I've seen it where you have to have, 3 to 6 months of reserves, the type of loan. And
when you say 1 month of reserves, that's 1 month of what?
Of your principal, interest, taxes, and insurance, enough to make that full payment. So,
Got it.
if you're buying a $500,000 house, and I don't want to scare people away with numbers, but it's $2,000 to $3,000 is probably going to be your monthly payment, somewhere in that range. Depending on how much money you put down, that's going to be your reserve requirement. So it's not daunting by any means. And most people want to have something in the form of reserves. And then we could also get creative. If someone has just enough for closing costs, but they don't have enough for reserves, we could build in, I know we did a separate section, lender credits. You could take a slightly higher interest rate and get a lender credit to offset some of your closing costs. Yep. Or a seller credit can be written into the contract. For whatever dollar amount that may be, obviously within reason, that's not going to impact the deal tremendously. So oftentimes, and I know we did another segment on that, oftentimes we can get some credits that will offset almost all your closing costs based on that unique scenario.
And based on who's in control in the market, buyers or sellers at the time of trying to get those credits. Yeah,
that is correct. So I think we're typically not going to ask for any more in reserves that what people aren't comfortable with. And I think, Rich, you and I have been doing this long enough. Is we don't want to tap someone that says, hey, every last penny you have, and you're eating top ramen for the next 30 days just so that you could save enough for your payment. We don't want to put anyone in that situation. So but we always go ahead.
Oh yeah, I think on this show we often advocate that you have a 6-month, emergency fund when you're, going to purchase a home. And again, we're not financial advisors. That's not financial advice, and we're not trying to tell you how to live. But for your own peace of mind, trying to develop that 6-month emergency fund so that you are in a good, strong position to buy a home and ride out whatever life throws at you will more than cover your reserve necessities, right? So if you've already been saving and trying to put yourself in the right financial position to purchase a home, usually the reserves are a non-issue. They're already covered. People just don't know that you actually have to have something. So occasionally we get a first-time buyer, we've had young couples in their 20s, fresh out of college, and they want to get in the real estate game. They want to start building equity, and they're really scraping and tapping every penny. And sometimes we have to say, you need to go save for another couple of months to really have everything you need.
Yeah, and one more point on that, when we talk about using qualified retirement funds that we could use, does not mean you need to liquidate those. You just have to have them to show reserve. So, you don't have to go tap, $2,000 to $10,000 from your retirement or your 401k to have it as reserves. Where it sits actively is counted as reserves, and we count a percentage of that. So if it's in a retirement account, and I want to say the number now is 60 or 65%. So, if you have $10,000 in a retirement account, we're going to count that as $6,000 in reserves.
Yeah. So most of you, if you've been working at your company for a little bit and they've got 401k or you've been matching with them, you've probably got enough sitting in the 401k to cover the reserves anyway. We just want you to know about it. That is a requirement that could be coming your way. You don't have to liquidate the funds. It's not a fee. You just have to have a little bit of extra money on hand. All right. The last one, and probably the one that feels the most like an actual hidden fee, and Dave on it earlier, is this supplemental tax bill, which is a bill you're going to get after the close of escrow, which makes people like frustrated, upset, blindsided. And so I tell you about this during the transaction 3 to 4 different times to remind you. And it's one of the primary things I do at the signing table with you, when Dave and I are sitting there, is reminding you that this bill is coming. And here's why it comes. It helps to not feel so blindsided about it if you know what's happening. You are paying the seller's tax rate in escrow. So when they're calculating the taxes you're maybe compensating the seller back for, or the taxes you are prepaying, they can only charge you the tax rate of the home right now that is legally recorded at the county recorder clerk's office. They cannot charge you your actual tax rate. And the reason for that is because the counties still maintain, frankly, what is a bit of theater, that they're going to come out and actually assess your home and give it a value and put that on the tax rolls. They will, by the way, come by. They'll knock on your door and say, I'm here to assess the property, and that will happen. But 100% of the time in the 20 years I've been doing it, the number that person puts down is the number you paid for the house. They're not independently appraising or valuing the house. So you can easily figure out what this is by the amount that you paid for the house. But technically, the county reserves the right to independently value the home, which means escrow can't estimate what that will be. So they can only charge you the tax rate that the seller has now. And then within 1 to 18 months, depending on when the market's really flying and they're really backed up and there's a lot of transaction volume, it can take a little while, but usually it's within 1 to 3 months because the county wants their money off of you. They're going to reassess the property at what you paid for it. And they're going to do that 1%, but you can estimate at that 1.25%. And they're going to charge you one time the difference between what you paid in escrow and what your new taxes are going to be. And they're going to send that in a bill in the mail. In rare cases, if your lender's overfunded the impound account, you may have enough in the impound account for it. You can always call your loan servicer and see if you have enough in the impound account and have them pay it out. But almost always you're going to have to pay this. So you have to save for this and plan for it up front. And we can actually teach you how to calculate it. We'll give you a natural hazard report that shows you exactly what their taxes are now. And you can do that 1.25% calculation or the 1% and add the special assessments that are shown on that report to get an exact number of what that's going to be if you really want to know. Just know within usually 1 to 3 months afterwards, you're going to have up to a couple $1,000 bill. Where this gets really big is if you're buying off some old people who have owned the house since the 70s and they've been protected by Prop 13 and they've never done a remodel or anything else that triggered a reassessment. They've just been hitting their 2% a year. Then this can be kind of a bigger discrepancy. And that's something we'll again show you on those reports. You can prepare for it. But usually this is $1,200 to $2,000 to $3,000 kind of a discrepancy.
Right. Yeah. I think that was a really good point you brought up, Rich. I was going to mention that as well. And we kind of can tell, when before you close or purchase the house, what the previous seller bought the house for, general idea of their tax rate. And so if they've lived there a short amount of time, and Rich and I have been doing this long enough and we've been seeing markets vary. So, sometimes people are selling their house at a loss and there's not going to be a supplemental tax bill. So that's rare,
Yeah.
but it's not always a crazy number. We just like to share with you that's coming at some point in time and be prepared for it. And we'll have a general idea of what that will be.
Yeah, it's a good point. I don't even mention it anymore that you could have not a
Yeah.
supplemental tax. But during the Great Recession, when people were losing their houses and everything was
Yeah.
going down in value, we actually did have a large span of time, several years, where you essentially weren't getting a supplemental tax bill, or where actual homeowners were going to the counties and saying, hey, my house isn't worth anywhere near what it was worth. And if they were keeping their house, they were asking to be reassessed downward. Very rare situation, one I hope we don't encounter again for all of our sake, but it can happen. Or if you have someone who's just bought a house and then unfortunately had to sell it right away, where the value is essentially the same, you can maybe not have a supplemental. But the vast majority of you will have some version of a supplemental tax bill. It isn't a hidden fee, but it is an unknown one, and this one can catch you out. We'll remind you of it many times during the transaction, but just so you know up front. So that this kind of, what's that, Dave?
Just be Perfect time just to mention this. Take 10 seconds, and I
Yeah.
know this is a stickler for you. After you close in escrow, you're going to get, once you close the transaction, it becomes public record. You're going to get solicitation in the mail from unlimited folks, people from dentist's office and doctor's office, people trying to,
Home Depot.
recruit Home Depot, yeah, for your business. But the one that really sticks with us is a copy of
Yeah.
your deed, and they want you to pay $75 and get a certified. You don't need to pay it. So call us if you get something and it raises an eyebrow as, do I need to pay this? Anything you get in the mail that's not the supplemental tax bill, you should not pay for anything.
It's a scam.
It's a scam.
Yeah.
Yeah. So,
Yeah, good point. Yeah, I mean, we try to save you any money anywhere we can, and it's only 50 to $100 that these scammers are trying to do. But you can get a copy of your deed for free from the title company that processed it for you, or you can go down to the county and for like 10 cents to print the thing off, you can get a copy. You don't have to pay anybody 50 to $100 for a copy of the deed. And by the way, you don't really need a copy for almost anything until such time as you pay the thing off.
right. And when the transaction closes, me and Rich, we don't, during the transaction, we're talking to you daily, sometimes multiple times a day. The transaction closes, and there's no real reason to communicate with us on a regular basis about the purchase transaction. But, I always get people, hey, sorry to bother you. I just got this in the mail. I'm not sure what it is. Never a bother. That's what we're here for. That's what we like. We want to be a resource beyond the close of the transaction. And that service never goes away.
Yeah. I always tell people we're not breaking up.
Yeah,
we're not breaking up on closing day. All right, so to wrap this up, we just went through a lot of fees, but we went over the upfront fees, your EMD, your appraisal, your inspection costs. We went over the closing costs, your reoccurring and non-reoccurring closing costs, and the fact that the bulk of those are actually you prepaying bills for yourself. We went over sort of some things that people don't really know about, reserves and your supplemental tax bill. Again, outside of the supplemental tax bill, all of this all up is going to be around 3% of the purchase price. That's all you need to know, but it can feel like you're getting nickeled and dimed and hit with fee after fee after fee when you look at the breakdowns. So if you just get it in your head right up front, do that 3% calculation. This is what I'm going to get hit with. And as long as the final number falls at that or below, in your transaction, wherever you are in the country, you are doing good. You're falling within normal limits on those fees. And anytime you get a fee estimate, which you're going to get from Dave, you're going to get from the title company, you can just always send those to us and we'll walk you through it. I'll go over one last thing. I know we're going to lose Dave here in a second. There's been a lot about commission and buyer's agent commission in the news lately. And we are going to do a whole episode on that for you. Know that the commissions are always negotiable. There is no set price, but they did change the way the commissions work. Historically, commissions were coupled together where the listing agent established all the commission and he was paying both agents. So as a buyer, your agent was being paid on your behalf by somebody else. And they decoupled those for transparency reasons. We can get into there was a lot of sort of ambulance chasing and money grabbing in the lawsuit situation there. But really, the result of this is just that. As a buyer, you have to agree upfront to pay your buyer's agent now, whatever they are going to negotiate. You can ballpark that at the 2.5% to 3% range, but it is always negotiable, and you work that out with your individual agent. However, you still can, during the offer process, request that the seller pay for that. And right now, we're only a few months into this. I've done 8 or 10 of these on both sides, listing and buy side. And so far, every one of them, we have gotten the seller to cover your buyer's agent commission and pay your agent directly on your behalf. So for transparency reasons, you are agreeing to pay your agent if somebody else won't, but you're always in the driver's seat to make that decision on an offer. If you were to decide to purchase a house where a seller stonewalled you and wouldn't pay your agent, then you could incur an extra 2.5% to 3% fee. That is never something that'll be a surprise. It's talked about upfront. Some of my buyers say, don't even show me ones where they won't pay you because I can't afford to pay you. Others say, let's just wait and see how it goes. For the most part, it's working out about the same as it always has for you, but that is an additional fee you could incur.
Yeah. Hey, Rich, on that note, for a seller and a listing agent, is it fair to say that sellers and listing agents are having that conversation and the seller's somewhat prepared to know that an offer is going to come in and ask them to pay the buyer's agent fees? Is that?
Yeah. And it's a in any industry, there are varying degrees of quality of the practitioners. So a high quality listing agent is going to go over this. So when I meet with my sellers, I'm going to say, look, the commissions are decoupled now. You're only paying me this. This is the percentage. We're negotiating it. Here's what we've agreed upon. However, it is likely that a buyer will submit an offer to you requesting agent compensation. And here is the range of what they may be requesting. So we should have that in our head that that's going to be a point of negotiation and something you might potentially pay, and sort of bake that in upfront. But you, Mr. Seller, are in the driver's seat to decide whether or not you want to do that. There are pros and cons that we can get into on another podcast. So far, all of my listing clients since the change have seen the value in offering a buyer's agent commission. They can't do it on the MLS anymore, but when people call me, we will say, yes, we're open to that. Put it in your offer. And, you know, if you're offering $100,000 less than we're asking, then maybe we're not going to pay your agent. But if you're making a reasonable offer, we're open to paying your agent. And so these conversations are now happening. They're much more transparent, and it's great. There is a small risk that it hits our buyer with an extra 2.5 to 3% fee, which that is the part I hate about this. But so far, I've been able to get that, baked into the transaction for all of my buyers, so they're not having to come out of pocket on that. But it is worth knowing that is a potential, and discuss with your agent wherever you are. This is national, so whatever state you're in, this affects you. Have a conversation up front with your agent. What happens if the seller won't agree to pay the fees? What's that going to cost me? Figure it out up front and make sure you have a plan for dealing with commissions moving forward, because it is different than if you bought a house multiple times. It's different than the last time you bought one. So, all right, Dave, I think that wraps up all of our 10 hidden fees, gives you an idea of what to expect when you're purchasing a home. If you have any questions, put them in the comment section down below. Reach out to us with a DM. We could spend 4 hours going granular on all of this, which wouldn't be of much value to you guys, but we're happy on an individual level to go granular with anybody who has any questions or specific scenarios they're struggling with. We're always here. Again, we're trying to help you make the highest quality real estate decisions you can from the comfort of your house, from your couch. And we are so grateful that you made it to the end. If you listened to Dave and I yak on for 46 minutes here, you are a rock star who's working hard to be informed and get the best possible experience of your real estate transaction. So you should be proud of yourself for that. Thanks for watching. We'll see you on the next one.
Thanks, Rich. See you.
Thanks, Dave.